All right. So, private to private transaction. There are three key issues that we need to confront in such a transactions. So, first, neither the buyer nor the seller is diversified. What does it, matter? Why does it matter? Well, it has to do with your discount rate. Remember beta? When we talked about beta, we talked about the marginal investor of the company, okay? Because the risk return trade off should be based on the perspective of marginal investor of that company. Look at the shareholder base, okay? If the primary shareholder, if the shareholder is like BlackRock, right? Or globally well diversified portfolio managers, you're no problem, okay? If that is the case, just follow CAPM and just do what we did in previous sections, right? No problem. But, 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 your private business, like fried chicken business, is BlackRock or Samsung 자산운용 your shareholders? No. Most of the time, you are the only shareholder. Okay? Plus, moreover, your characteristic is that 100% of your wealth is invested in this business of chicken frying. Okay? In Korea, there's, cynical way of saying BCD, right? BCD. Life is something between B and D, birth and death, right? And then C is in between. What is it? Chicken frying, they say. You can work as other companies' employees, but after a certain point, you start your own business, but there's not much of a business chances, so that you end up frying chickens, right? And then that's your sole proprietorship business, right? ABC. C, right? 100% of your wealth is tied upon to this business. Now, what is the problem over there? There, all the firm-specific risk matters. Okay, so you have to worry about all firm-specific risk, unique risk. For coffee shop or all these things, right? If 100% of your wealth is tied up to this business, then you have to worry about all idiosyncratic risk. Whether your local community is in negative or positive shock of income. For example, your local community is hit by COVID-19 or not, okay? You're screwed altogether like that. So you have to adjust. You have to adjust your beta, okay? Market beta. Essentially, easily put, you will divide your beta by correlation coefficient with the market. I'm going to tell you why later. Wait for that. Which means inflating your beta, making your beta big so that your discount rate will be bigger. Okay? So that discount rate bigger, the whole valuation number will be smaller. That's number one. Number two, investment is illiquid. Illiquid, what do you mean? Hard to sell instantaneously. Difficult to find buyers for your company, so that you will have to cut down your price a lot more when you want to really sell it. So there will be some liquidity discount. Number three, key person value, which means if a lot of your customers and clients are coming to your restaurants because of the star chef, you will have to care about this chef's value, so that once you sell off this company, the chef goes away to a different company, a third party, right? Then he will be or she will be taking away those clients and cash flows to the other company, not this business. So your value of your private business will go down even further. So this kind of things, you have to worry about it. An example, valuing a restaurant. Assume that you have been asked to value an upscale French restaurant, français, à la carte, and for a sale by the owner, escargot, right, who also happens to be, vive le français, right? So happens to be the chef. Both the restaurant and the chef are all regarded, well regarded, and business has been going good for lasted 3 years. The potential buyer is a former investment banker who is tired of rat race or like a meaningless competition, has decided to cash out all his savings and use the entire amount of money to invest in this restaurant. You have an access to the financial statement for the last 3 years of the restaurant. In the most recent year, they reported $1.2 million, 14억 원, all right, in revenues and $400,000 in pre-tax operating income, like a 5억 원 kind of business. Okay, while the firm has no conventional debt outstanding, it has a lease commitment of $120,000 each year for the next 12 years. So you are not 건물주, like a 조물주 위에 건물주, but you have to worry about this rent expenses, and that works like a financial expenses. If you fail to pay this operating lease, then you're screwed. Essentially, you will hit the bankruptcy. So this is just like a financial expenses or bank borrowing kind of things. So let's treat this operating lease expense as one interest expense, right? That's the idea going on over here. But for your I-Corp purpose, you don't need to worry about this part. And for your exam purpose, you don't need to worry about it. Why is that the case? Because last year, the accounting rule changed in Korea so that there will be no operating lease from now on. All the lease obligations should be capitalized so that everything has to show up on the balance sheet in the form of financing lease. That is one of your debt item, okay? Debt, interest-bearing debt. So those lease expense will be treated just like interest expense from now on. So you don't need to worry about it, but for the textbook's purpose, I'm going to go through that part. Past income statement looks like this 3 to 1 year ago, okay, on the horizontal axis. Vertical axis, you see revenues, operating expense, wages, material, other operating expenses, operating income, tax, and net income are shown over there year by year, okay. You have revenues have been growing up, operating at full capacity. Operating lease expense you've taken out from this. Well, you're gonna treat this guy, okay, as interest expense, okay. You're gonna capitalize it. I'm not gonna ask you for this part in your exam, so don't worry about it. But the thing is, there is a 12 years maturity to 12 years left on the lease, and then the wage to employees, right? Owner and chef does not draw salary. Okay. Owner chef, right? The owner chef, like the guy, like a star chef, let's say, not you, okay? Owner of this restaurant does not draw salary from here. He was getting a dividend, okay. So once this restaurant becomes your restaurant, you'll have to increase this salary to hire chef instead, okay. Later, wages. Come on, not this one. The wages, right? This part. Now, material expenses. Well, that's 25% of revenues. Other operating expenses, 15% of the revenues. And then taxes, 40% tax rate, and the net income, you see it now. Next slide. Estimating discount rate. We first have to take care of the discount rate, okay? What is the characteristic of the marginal investors of the company that I told you before, right? Undiversified, right, investor. So conventional risk and return model in finance are built on the presumption that the marginal investors in the company are diversified and that they therefore care only about the risk that cannot be diversified. That risk is measured with a beta or betas, usually estimated by looking at past prices and returns. This valuation, both assumptions are likely to be violated. So as a private business, this restaurant has no market price or returns to use in estimation. You're screwed. There's no regression beta. Okay, but what? you have bottom-up beta. Okay, so look at the peers who are traded in the market, similar industry, restaurant business, for example. And then we will use bottom-up beta, but that's not the end. We will do one more thing. The buyer is not diversified. In fact, he will have his entire wealth tied up in the restaurant after the purchase, right? Now, the average unlevered beta across 75 publicly traded restaurants in the US is 0.86. Now, watch out. Most of the publicly traded restaurants on this list are fast food chains, McDonald's, Burger King, or mass restaurants like Applebee's and TGIF. There is a argument to be made that the beta for an upscale restaurant is more likely to be reflecting high-end specialty retailers or luxury goods than it is than these restaurants. So the unlevered beta for the unlevered beta for 45 high-end retailers, right? High-end retailers or luxury goods is 1.18. So you looked at the restaurant business beta, but let's focus on luxury goods beta. Okay, 1.18. That's the argument over here. 1.18 will be our starting point. Then what? Unlevered beta. Okay, unlevered beta, remember this over here, unlevered beta. All right. Now, private ownership. Here, we are talking about increasing the unlevered beta. Okay, why? Because the marginal investor is not a well-diversified portfolio manager, but individual investor who is 100% tied up on this single business. So we are exposed to the whole risk, total risk of the business, instead of market risk of the business. So what's the idea over here? The rectangle over here, the huge whole rectangle is a total risk. Okay, total risk. Total beta is the one we're gonna use later on. Total beta measures all risk, okay, which will be market beta divided by the proportion of the total risk that is market risk. Okay, so let's say here we started market beta measures just the market risk, and then the market beta will be this guy, right? Let's say if the total risk, if we assign 100 unit, 100%, okay, the total risk is 100 unit of the risk. If we say like that, let's say for this kind of case, right, of restaurant business, only 20% of this total risk happens to be market risk. Okay, then the remaining 80% must be the firm specific risk. Okay, firm specific risk. So beta should be about the beta that you get with the regression, or unlevered beta should be about this 20% unit, right? So these publicly traded companies with investors who are diversified will care about this beta, and then the demands cost of equity that reflects only the market risk. That was what we used to do, okay, in the public company valuation. You did not have to worry about this firm specific risk, but we have to take this firm specific risk into our calculation. So what do? Well, let's find a way to inflate this guy to include all 80 units of firm specific risk. Private owner of the business with 100% of your wealth, right, invested in the business, right? This is firm specific risk is you are exposed to all this kind of risk in the firm, and it demands a cost of equity that reflects firm specific risk as well as market risk. So that will be our concept of total beta, right? The beta that reflects not only the market risk, but also, not only the market risk, but also the firm specific risk incorporated, right? So total beta, how do we calculate this, right? To get from the market beta to the total beta. By the way, market unlevered beta, right? The total beta, we need a measure of how much of the risk in the firm comes from the market and how much is firm specific. So looking at the regression of publicly traded firms that yield the bottom of beta should provide an answer. So the average R squared, right, across the high-end retailer regression is 25%. At one point I told you that R squared tells you about how much of a total risk is explained by market risk in the regression, in the characteristic line. So company by company, you run the regression of company's return against the S&P 500 or market index return, right? 25% on average, 25% of these guys is explained by market risk, okay? So remaining 75% must be coming from the firm specific risk on average. So since the betas are based on standard deviations rather than variances, we'll take correlation coefficient, okay? As it turns out, R squared means what? R squared in a single variable univariate regression, R squared means correlation coefficient squared, R squared. Remember correlation coefficient, we call it rho, the Greek letter rho, okay, which corresponds to R in English alphabet, R squared, okay, it comes from this linguistically, right? Now, we will take the correlation coefficient as our measure of proportion of the risk, that is market risk. All that I'm saying is this R squared is about the variance. Okay, R squared is about the variance, whereas what we are interested in is a standard deviation, which is the square root of variance and then square root of not equal over here. Variance is about the square root of, the standard deviation is the square root of variance. And then this guy, analogously, not equal, analogously, we have to take the square root of R squared, which is R, or it should be correlation coefficient rho, okay? Now, so we will divide our beta, market beta, or unlevered beta, I would say unlevered beta, by correlation coefficient like this. So correlation coefficient in this case 0.5, so divide market beta, unlevered beta, by correlation coefficient, that gives me 2.36. all right? Now mathematically it works like this. Remember, your beta was covariance over variance of your company's return against market return. And then if you expand the math, it looks like this. The market standard deviation of the market return cancels each other out, so that you end up with this. Now, the total beta means your beta, that's this guy, divided by correlation coefficient, which is this guy, right? And then that division tells us that, well, bring this guy in, okay? And then cancel each other out. The remaining part will be this. Standard deviation of your stock's return divided by standard deviation of market index return. So you are just normalizing the total risk. Remember, your total risk of the stock is whole standard deviation of your stock return, okay? That total risk normalized by market portfolio's total risk, okay? Remember, our risk return model has to have some kind of translation mechanism, so that translate your risk into expected return. The beta works nicely because it was translating using this standard deviation of your market index return. Similarly, you have market index returns standard deviation as a translator. So that's why, it works. Total risk measure is total beta, which is beta divided by correlation coefficient over there, okay? So we're going to play with this idea going further. Now, for example, here is a Cheesecake Factory. Because we are talking about restaurant business, there's one publicly traded restaurant company called Cheesecake Factory. in the US. Their monthly return over the past 5 years happened to be like this. So I do run a regression against S&P 500 index return over the same period. Now using the scatter plot approach, and I get what? The market beta as well as R squared. 1.4 market beta, okay? And then Cheesecake Factory's beta is 1.427. I want to get to total beta, okay? For example, of course, it should have been Cheesecake Factory's unlevered beta, but let's assume, okay, for the sake of simplicity, forget about the leverage ratio, but let's assume this is their unlevered beta. Forget about the debt. Assume this is unlevered beta, okay, your business risk. So that, and then how do you get to total beta based on this information? Well, correlation coefficient, you want to get it so that you divide it, okay? Now, how do you get the total, the correlation coefficient? Well, R squared, that you see it over here, 0.366, right? Well, take the square root of it, okay? Because this guy is nothing but the correlation coefficient squared in the first place. So you divide the beta by 0.6, you get 2.36, right? So that's going to be your total beta. Of course, one procedure that I skipped is getting the unlevered beta, okay? But anyway, so that's that. Now we move down to the final step in beta computation. Estimate the debt to equity ratio and cost of equity, because your total beta should be unlevered beta sense. With publicly traded companies, we relever beta using the market debt to equity ratio for the firm. With private firms, this option is not feasible. We have two alternatives. Assume that the debt to equity ratio for the firm is similar to the average market debt to equity ratio for the publicly traded companies in the sector, and use your estimates of the value of debt and equity as the weight in the computation. There will be a circular reasoning problem. You need the cost of capital to get the values and the values to get the cost of capital. But take one starting point that you have to work on it. It's okay. We will assume that this privately owned restaurant will have a debt to equity ratio of 14.33%, similar to the average publicly traded companies, even though we use retailers to the unlevered beta. So levered beta, assuming 0.1433 debt to equity ratio. So you start with total unlevered beta 2.36, and times the Hamada equation, 1 plus 1 minus tax rate times debt to equity ratio. So that's 2.56. And then the cost of equity using CAPM, well, market risk premium being 4%, T-bond rate 4.25%, and then if you do the math, you will find 14.5% to be your cost of equity. All right. Now, the next slide, estimating cost of debt and capital, WACC, right? While the company does not have a rating or any recent bank loans to use as reference, it does have a reported operating income and lease expenses treated as interest expense. So coverage ratio should be operating income divided by interest expense, which is lease expense. So 400,000 divided by 120,000, which is 3.33. And rating based on coverage ratio, well, double B plus. Default spread for this rating, 3.25%, based on the table of ratings and the default spread. So after tax cost of debt should be risk-free rate plus default spread times 1 minus tax rate. That will be 4.5%. To compute the cost of capital, weighted average cost of capital, we will use the same industry average debt ratio that used to lever the betas, right? You notice this one. Here, weight of debt on equity, weight of equity, right? We don't have market value based weights, right? So what do we do? Well, based on market value based debt to equity ratio of MVD, MVE 0.1433, right? These market value based ones come from your industry peers in publicly traded companies. You're borrowing it, not from your own company, you're borrowing it from the publicly traded companies. Okay. The idea is if this company were traded in the market, this should be their debt to equity ratio, market value based debt to equity ratio. Based on this, what can you infer? Well, your weight of debt should be nothing but debt over equity plus debt, right? Now, what? We know that your debt should be 0.144 of your equity, of your, how do I move this guy? Good, equity, right? So if you do the math, bring this guy to the other side of the equation, right? Equity, debt over equity, like this. Oh, no. Sorry. So if you do the math, debt over equity is 0.144, right? That tells me that debt should be 0.144 equity, so that when you compute the weight of debt and equity, right, debt plus equity, it should be 0.144 equity over 1.144 equity. Makes sense? Because you have 1 equity and 0.144 equity over here. So that's why. Now, cancel each other out, equity, right? The remaining will be 0.144 over 1.144. So that's what's going on over here. So weight of debt should be 14.433 divided by 114.33, okay? And then the other weight, right, the other part will be 100 over 114.33, right? So that's the weight of debt and equity. Now cross multiply the cost of each item, and then you'll get weighted average cost of capital of 13.25%. So that's how we do the math. And then clean up the financial statements, right? Step 2. The thing is, your operating lease expense is the one that we have to worry about, okay? Operating lease expense. I should change my color. Operating lease expense. Leases are financial expenses, so we take it as interest expense. But the thing is, in how do we treat this operating lease as capital lease? Well, we first get the present value of all lease obligation. So the present value of $120 million of lease expense over 12 years horizon, discounted at 7.5% cost of debt. Okay, where did you get the 7.5% cost of debt? That comes from the cost of debt calculation over here, right? 7.5% cost of debt. Okay, you take it, then discount $120 million, right? Again, I'm not going to ask you this question in your final exam or at all, so don't need to worry about it. But just in case you wonder where this interest expense come from, this is an attributed interest expense. The attributed coming from the present value of your future lease obligation. every year you need to pay $120 million. So what's the present value of it? 928.323 million dollars. That's your attributed debt amount, okay, associated with your lease obligation. And then the idea over here is that based on this debt amount, every year you pay 7.5% of interest out of it. Okay, so take out the operating lease from your expense items and stick in your periodic interest attributed. Okay, that's how it goes. Okay, but I'm not going to ask you this question in your exams. Don't worry about it. Anyway, so that's how we adjusted it in previous accounting regulation. And then wages, I said you have to increase this wage because before you purchase this restaurant, right? The restaurant belonged to a chef, okay, the star chef maybe. And then the guy was the owner, so his wage was not included in this wage. It was just for the waitresses and then the waiters, not the chef. Now, as you take over this restaurant, the chef says bye-bye. You have to hire a new chef. So the new chef, their salary will be $150,000 per year. 1억 7천만 원 돈. Wow. Okay. So that's gonna be your new wages, and then material cost, keep it the same. Other operating expenses, keep it the same. But if you do the math, your operating income will be $370 million instead of $400 million. And the interest expense will be like this, 69.62. Okay? And then your taxable income will be only $300 million. I don't know, $300,000. And based on it, 40% tax is taken out. Your net income, $180.23 million, $180,000. That's going to be it. Now, the next slide. Step 3. Okay, step 3. Assess the impact of key person. A part of the draw of the restaurant comes from the current chef. It is possible and probable that if he sells and moves on, there will be a drop of revenues because a lot of the customers came to see this chef. For example, Airong Shefu. If your business restaurant is about sushi, right? A lot of these high-scale sushi restaurants, it's like the chef individually serves each dish. One sushi. This is maguro. Hajimemashite. And then people like the feeling of being served, personalized serve. Oh, you came here, and I know you like this temaki in a certain way. Instead of temaki in a different way, I serve it for you. And this kind of chef service, right, attracts a lot of customers and patrons. And the chef leaves, and you have to take care of this kind of things. And then drop of revenues. Yeah, if you are buying the restaurant, you should consider this drop off when valuing the restaurant. Thus, if 20% of the patrons are drawn to the restaurants because of the chef's reputation, the expected operating income will be lower if the chef leaves. 20% or 40%, how do you know it? Well, that's where the marketing survey works nicely. So before you take over this company, you'll have to do marketing survey for the visitors and customers, okay, around, and to have some good sense of it. Now, adjusted operating income should be there with the existing chef, $370,000, let's say, 370 with the existing chef, okay, right. Of course, you increase the $150,000 of wages over here, but that's not what we are talking about. Okay, what we are talking about in the next slide is about your operating income, the profit coming from the patrons. Okay, now adjust this guy, knock it off by 20% because you assess estimate. Those guys will fly away. With the chef, as the owner chef of the restaurant, what might you be able to do to mitigate this loss in value? Okay. What worries you? Okay. What worries you more is that what if this chef, right, creates a similar restaurant right next to your store, next door, okay, and screw up your business? You will be, totally pissed off. So legally, okay, you want to make a contract with this guy so that the guy will not create his business in X kilometers radius of your business, right? Your store. Okay? You promise me you're not going to create the restaurants right next to my door. Or you make a promise, right? You will still work for me, okay? For maybe the next 2 years, 3 years down the road, okay? You make a contract with the guy. Depends on your negotiation skills, I guess. Step 4, don't forget valuation fundamentals. To complete the valuation, you need to assume an expected growth rate. As with any business, assumptions about growth have to be consistent with reinvestment assumptions. In the long term, the reinvestment rate has to be expected growth rate divided by your return on capital. I told you return on capital is very important metric. In this case, we will assume a 2% growth rate in perpetuity and the 20% return on capital. So the reinvestment rate will be 10%, which is 2% divided by ROC. Even if the restaurant does not grow in size, this reinvestment is what you need to make to keep the restaurants both looking good and working well. It's remodeling a little bit, and then how do you say, renovation, right? And then new ovens and appliances and all these kind of things. We call this kind of capex a maintenance capex. 5. Complete the valuation, right? Inputs to valuation, you're almost there, right? Adjusted EBIT, $296,000. You pay tax 40%. Of course, you need FCFF, so you'll have to think about the reinvestment rate to get to FCFF1. Once you get FCFF1, all you have to do is divide it by WACC minus G. The WACC 13.25%, sorry. Growth rate is 2%, and to get to FCFF, you need reinvestment rate, 10%, I said before. So NOPAT times 1 minus reinvestment rate, that should be your FCFF1, okay? So valuation, the value of restaurant would be expected FCFF1, which is next year. And then cost of capital, right, divided by these things, right? So that would be $1.449 million if you do the math, right? Value of equity in this restaurant, right, will be $0.5 to $1 million because we subtract one important debt amount that we talked about before. Remember, on the way, we assumed a debt amount coming from your operating lease obligation, the present value of lease. Present value of the lease, what is that? Over here, present value of lease. I told you before, accounting rule in Korea nowadays, there's no operating lease from now, but everything is financing lease, so this lease obligation will be on the balance sheet anyway. So you don't have to worry about getting the present value of this operating lease, but notice that this financing lease will be there for you anyway, okay? So you take out this lease obligation, okay? Then you get $500,000 worth of equity value, okay? 5억 원어치 or 6억 원어치, right? Now, step 6, consider the effect of illiquidity. You're not done yet, right? Liquidity discount has to be there. Private company valuation, illiquidity is a constant theme. All the talk right, though, seems to lead to a rule of thumb. The liquidity discount for a private company is between 20 to 30% discount and does not vary across private firms, but illiquidity should vary across companies. Healthier and larger companies, less discount because people are more willing to buy. Weaker companies or smaller companies, more discount, deep discount, because the lack of negotiation, how do you say, bargaining power for you, okay? Not many people look at you, less of a demand in the first place, okay? So the deeper discount. And time, liquidity is worth more when the economy is doing badly. Liquidity is worth more, which means you get more liquidity discount in troubled times. Credit crunch or COVID-19 kind of disaster happens, then all the monies in the market gets frozen. So scared. Okay, they don't want to invest. No market is there for you in private business. Deeper discount. That's what I'm trying to say. Buyers, liquidity is worth more to buyers who have shorter time horizon and greater cash needs than for longer term investors who don't need the cash and are willing to hold the investment. So it's the owner's perspective as well, right? The owner of this private business, if he or she needs to sell off quickly, right? In a rush, more discount. 후려쳐, even more. Oh, you're in need of cash. I can take advantage of you even more. So, right. So estimating the illiquidity discount for the restaurant, well, let's just take a half of the middle number of illiquidity discount, 20% to 30%, 25% discount, right? And then apply it to your valuation number, $500,000. So if you do the math, you will find it to be $0.391 million, which is like 4억 won kind of, a value. All right. Of course, depending on the liquidity model, you can, adjust this, your estimate. But that's something out of the scope for this class today. Anyway, private companies sold to publicly traded companies is the next one. Remember, the first one was the private to private transaction. Why did you have to apply total beta? Because of the buyer, the once it is taken over by this new owner, right? Is the owner, the primary shareholder over there, marginal investor, is it well diversified or not? Was a problem. Now here, private to public, new owner, right? The shareholder base of the new owner, they may be well diversified portfolio managers. So let's see. The key difference between the scenario is that the seller of the business is not diversified, but the buyer is, or at least the investors and the buyers are diversified. Consequently, they can look at the same firm and see very different amount of risk in the business, with the seller needing more risk than the buyers, right? So the cash flows may also be affected by the fact that the tax rates, also the cash flows may also be affected by the fact that the tax rates for publicly traded companies can diverge from those of a private owners. It has to do with the marginal tax rate. Finally, there should be no illiquidity discount to the public buyer, since investors in the public buyer can sell off their holdings in the market. Okay, once it becomes a part of publicly traded companies, right? Then the shares of the public traded companies, there's no such thing as liquidity discount, right? So revisiting the cost of equity and capital, it works like this. When the buyer is public as opposed to private, you start with unlevered beta, okay? In private to private transactions, you needed the total beta, but private to public, you don't need total beta, okay? It's just unlevered beta, okay? 1.18 in our example before, okay? 1.18. Debt to equity ratio 14.33%, tax rate 40%, pre-tax cost of debt 7.5% the same, levered beta will be different, 1.28 only in this case, right? I'm going to take this guy into this part. It's much better. Now, good. Risk-free rate the same, equity risk premium the same, but the cost of equity is a lot lower because your marginal investor of the buyer is now well-diversified portfolio managers like BlackRock. Now, after-tax cost of debt the same, the WACC is a lot lower, which means your value estimate will be a lot higher. So, let's see. Revaluing the restaurant to a public buyer, right? Value depends on the characteristic of the buyers, marginal investor of the buyers. Makes a difference. So, adjusted EBIT is the same. I have to delete this guy, right? The key person discount 20%, EBIT adjusted should be the same. The expected growth rate 2% the same, return on capital, reinvestment rate the same, FCFF the same, cost of capital different. So that the value of the business is a lot higher, $2.4 million. Wow, 26억 won kind of, you know. And minus debt, yeah, the present value of lease obligation, fine. The value of equity, almost $5 million instead of $0.5 million. And then no illiquidity discount, so that the whole amount of $1.5 million goes to equity holders, right? So that's the valuation, private to public transaction. Now, good. Then, so what price should you ask for? Assume that you respect the chef owner of the restaurant and that you were asking for a reasonable price for the restaurant. What would you ask for? $454,000 or $1.484 million or some number in the middle. Okay, so if it is some number in the middle, what will determine the what you will ultimately get for your business, right? How would you alter the analysis if your best potential bidder is a private equity or VC fund rather than a publicly traded company, right? These two bullet points draws interesting questions. The first bullet point, it really depends on the situation in case by case, and your bargaining powers, and then how do you negotiate all these things, right? Number two bullet point, VC in the middle, right? Over here, okay, in this case. Well, let's think about it together in the next slide. Private company for IPO is the next thing, okay? But VC, right? Before we move on further, VC setting or private equity. Well, for VC and private equity, if you're selling it to them, you'll have to think about who is are these VCs well diversified enough, right? VCs, typically they are not well diversified, okay? So they are partially diversified. So your division, getting the total beta process will be adjusted a little bit. So let's look at it later on, okay? The next slide, private company for IPO. In an initial public offering, the private business is opened up to investors who clearly are diversified or at least have the option to be diversified. There are control implications as well. When a private company goes public, it opens itself up to monitoring by investors, analysts, and markets, right? A lot of companies, there's a choice, right? Whether you go for public or private. The CEO, okay, they choose, right? Optimally, okay, optimally. There are some reasons, advantages as you go public, IPO. What? Well, you can attract a lot, you can raise a lot bigger capital, right? So that you can invest in a huge scale, okay? The drawback of this is intensive monitoring, okay, the drawback, okay? So there is a trade-off. As you go public, a lot more monitoring comes to you. So uh, you have to be very, very careful. You're under scrutiny, okay, of analysts, very much. So if you make a mistake, or if you miss their expectation by a cent or two in your quarterly net income or EPS, earnings per share, you're screwed, right? Your share price will plunge like crazy. So you will be very, very nervous about your company's performance in the short run, right? So that's one drawback of going public. So this is partly why the public companies who already went to initial public offering, they choose to go dark or go choose to take out, buy back, and then buy out, and then become a private company at certain stage. Oh, I don't want to be bothered by stock analyst quarter by quarter. I, I'm gonna do my business in a nice way, okay, in a reliable way in the long run. That's why Tesla's CEO Elon Musk at one point last year said, I want to go for LBO or kind of a buyout process. I don't want to get bothered by those analysts in the market. They are too much short-term oriented. They don't understand me, okay? Take it to private. He was talking like this before. Why? Because of this concern, short-termism, right? Of course, there's a room of debate about whether being public is really making the company more short-term oriented versus not. Okay, but that was why the Elon Musk was saying that. Still, Elon Musk company, Tesla, is public. Okay, he got warning from those security exchange commissions saying those kind of things, right? Spooking the investors. Anyway, so the opening, what's that? The last bullet point, okay? The reporting and information disclosure requirements shift to reflect a publicly traded companies, okay? Now, Twitter IPO is shown over here, okay, as a textbook showcase. The IPO, if you are valuing your company as an IPO, you don't need total beta. Why? Because once it is sold off to general public, who is going to be the marginal investor of your company? BlackRock, kind of well-diversified portfolio managers. So your marginal investor being like that, your beta will be unlevered beta that we used to calculate before. Right? You're just another public company, so you don't need to do total beta job. Okay, just do as you did before. Okay, no total beta thing. If you go through this item by item in DCF valuation of Twitter in 2013, you will pretty much see that those items and then the work over here, all those are just like what we used to do. Okay, risk premium and CAPM, all these kind of things, and then the cash flow projection over the next 10 years is no adjustment. Okay, simply because it's a private company anyway, because the buyer is a public, right? The only difference will be this guy. Okay, the only difference will be this guy. Of course, the first step, you get the firm value, which is enterprise value or operating asset value. Okay, which is the present value of FCFFs over here. Okay, all these guys going into the future, right? Discounted at WACC, and then don't forget to add cash. And then the only difference from our previous FCFF framework is just add IPO proceeds, right? Once you do the IPO, what are you doing over here? Well, you get the cash, right, from the general public. That's IPO proceeds. In this case, $1 billion. All right. So what are you going to do with this is the next question. But let's postpone that question a bit further down the road. Okay. Right now, this is going to be your additional cash, right? Available in addition to the existing cash in your bank account. So add those cash proceeds and cash together, and then subtract debt and get to the equity value. There you subtract options, that is the payment going to the CEO and the chief executives or your employees in the form of option exercises, right? The bonuses kind of things. So value of options, let's assume that you got the fair value of options in those cases. So take out those option value, okay? And then you'll get to the market value of equity available to common shareholders, now divided by the number of shares outstanding, get to the fair value per share. So this is the IPO valuation. Quite easy, right? So just like what you did before, even though the company is a private company, right? You do the same framework as publicly traded companies. The only thing that you have to worry about is cash proceeds that you get, okay? We'll talk about it later. No need to worry about it, okay? And then the twist in an initial public offering, the valuation issues is that the use of proceeds from the offering matters. The proceeds from the offering can be held as cash by the firm to cover the future investment needs, paid to existing equity investors who want to cash out, or used to pay down debt. Okay, all these kind of different usages make difference in your valuation in IPO. Warrants and special deals with prior equity investors. If venture capitalists and other equity investors from earlier in iteration of your fundraising have rights to buy or sell their equity at pre-specified prices, it can affect the value per share offered to the public. In your semester's final exam or in your I-Core, no need to worry about this kind of things. Just take the value as claimed, as given, right, as market value, because you don't know how to calculate all these things. And then pricing issues, institutional setup, about how to price those IPO prices, right? Well, institutional setup is that most IPOs are backed up by investment banking and then it guarantees on the prices, which can affect how they are priced. So, and then the follow-up offerings also matters. The proportion of the equity being offered at the initial offerings and subsequent offerings plans can affect pricing. Now, the use of proceeds. The proceeds from an IPO can be, one, taken out of the firm by existing owners, two, used to pay down debt and other obligations, three, held as cash by the company to cover future reinvestment needs. How you deal with the issuance will depend upon how the proceeds are used. Number one, if it is taken out of the firm, ignore in valuation. If this is used for partying purpose for the existing shareholders, that can happen, right? Number two, if it is used to pay down the debt, well, change the debt ratio. Okay, your debt amount reduced. Okay, so it will affect your market value of debt and equity in your WACC calculation as well as beta calculation, right? The value number will change. And then if it is held as cash to cover future reinvestment needs, we'll add the cash proceeds from the IPO to the DCF valuation of the company. Okay? And then how much, right? IPO proceeds. News stories suggest that the company is was planning on raising about $1 billion from the offering, and the usage was that in the Twitter prospectus filing, the company specifies that it plans to keep the proceeds in the company to meet future investment needs. Okay. In the valuation, we have added $1 billion to the estimated value of the operating assets because that cash infusion will augment the cash balance. All right. Now, how would the valuation have been different if the owners announced that they plan to withdraw half of the offering proceeds? Well, the amount of the cash, the proceeds should be halved, right? So that's that. Now, claims from prior equity investors. When a private company goes public, there are already equity investors in the firm, including the founders, venture capitalists, and other equity investors. In some cases, these equity investors can have warrants, options, or other special claims on the equity of the firm. If existing equity investors have special claims on the equity, the value of the equity per share has to be affected by these claims. Specifically, these options need to be valued at the time of the offering and the value of the equity reduced by option value before determining the value per share. But this part, you need to worry about it in the more advanced classes. Now, let's take the perspective of investment bankers who is really working as a middleman to bring a private company to the public, right? Almost all IPOs are managed by investment banks and are backed by a pricing guarantee, where the investment banker guarantees offering price to the issuer. Okay, you poor private company, don't worry. You will get cash proceed over X amount. I guarantee you. Okay. Now, if the price at which the issuance is made is lower than the guaranteed price, okay, the investment banker will buy the shares at the guaranteed price and potentially bear this loss, right? You are sitting on this IPO amount, taking the risk. For free? No, there's no free lunch, right? So what do? It's no surprise that most investment banks write in a 15% discount into their manuals on how to set the offering price for an IPO. So you first of all, you get the fair value per share when you do the IPO, and then the initial launching price, right, to the market will be 15% off of that value, right? So that this is working as a fee kind of things, as a compensation for the bankers to the taking such risk. Now, pricing versus value. Well, earlier we assessed the value of equity at Twitter to be $9.97 billion. That's DCF valuation. Remember, DCF is just one of many ways of getting the values. So this is not a fixed God-given price value, right? Now, assume, however, the market appetite for social media stock is high and that you pull up the valuation, relative valuation measures like this, other publicly traded companies in the market. For example, Facebook and LinkedIn, okay? So you see it in the table, Facebook, LinkedIn, and theirs, right, aggregate amount, right? And then Twitter, we don't have their enterprise value yet or market cap yet because it is not traded in the public yet at the end of 2013, right? But we have industry competitors' enterprise value and market cap like that, and sales amount is there. Twitter, you have sales amount because they announced the accounting numbers before IPO anyway. Now, user numbers, right? The subscriber numbers are also available if you collect those data. Those are here. The relative valuation measures are over here. EV to sales and market cap to users, right? EV to sales, we played with this before in Disney's case, right? Enterprise value divided by sales. So that is 17.45 for combined, right? Or average maybe, right? For this Twitter and LinkedIn. Now, if we use this one, you can apply this to Twitter. Given that you have sales amount, you multiply this guy 483 by 17.45. Okay, that may give you some $8 billion worth or something. And then market cap per users is another measure of relative valuation. For each user subscriber of your service, how much of a market cap are investors willing to pay, right? So that's $102, $2.8 per user. Now, given that you have 215 million users, multiply this guy by the metric, and then you will get about 20 billion dollars, okay, of market cap. Okay, of course, EV to sales ratio multiplication, you must get EV first, and then get the cash added. By the way, this guy, EV plus cash plus IPO proceeds minus debt amount. So market value of equity should be like this, minus options payment. So I skipped all those things in saying, but $8 billion about, and then $20 billion about, right, for this guy. Now, DCF valuation about $10 billion, which is in between 10 billion, right? Then you have a whole range of valuation number. Holy cow, which is the right and correct absolute value, right? Absolutely correct number. No, there's no such thing as absolutely correct number, right? But which one would you choose, right? And should be a fair value. That depends on the negotiation with the bankers and then the market sentiment at that IPO time, all these kind of things. That's something to you have to learn later on as you go into the industry. Now, the IPO underpricing, I told you about this 15% discount, right? Fair value, you get it, whether 20 billion or $10 billion, you get it. But the investment banker will always say 15% knockoff from there. And then that will be your initial price set. So here is the chart that shows the something called IPO or underpricing. Okay, what is that? On your horizontal axis, you have a whole size group of the companies, small size all the way down to big sized corporations doing IPO. What you see on the vertical axis, the initial day stock price return. Okay, on the day of the IPO announcement, right? IPO is done, let's say 9 a.m. in the morning. Typically, in the New York Stock Exchange, if you pay the fees, they give you a celebration that ring the bell, ding, 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 and then you will be televised in the CNBC kind of media. Okay, your stock begins to trade at the morning 9 a.m. Okay, there must be initial price set. That's what I mean by initial price of IPO, and then that is the point. That is where the 15% knockoff happens from your initial valuation number because of the investment bankers charging, right? Now, not just charging, but they just discount it. Why do they discount it? Okay, why do they discount it like that? Because they bear the risk, first of all, risk of not being able to sell not being able to sell this IPO's shares to the market. What if they cannot sell it? Okay, so lower price, there will be higher demand, right? Supply and demand. So knock off the price, and you'll be able to sell it easily in the market for their purposes, right? That's the idea. And number two, you see initial day return, right? So 9 a.m. price versus 4 p.m. or 3:30 p.m. price. There must be some price movement, and on average, you see about 16 or 15% upward movement on IPO. Okay, so initial day there seems to be like a IPO underpricing going on. Okay, so turning around, it seems like there's a lot of room for making money, but is it risk-free, guaranteed price, guaranteed return? The answer is no. There's a huge risk, actually, huge risk associated with this average high return. Average high return. What risk? Not being able to sell even with the discount of 15% or more, right? A lot of stocks are under the radar, going bankrupt or whatever. They're not being able to sell. Those are not shown in the data. Okay. So if you blindly take a position on IPO stocks, okay, there are some stocks with a lot of stocks not were sold at all in the IPO, going under the initial setting price. Okay, So that risk is huge. That's what I'm trying to say. Number four, right, an intermediate problem, right, the private company valuation. When your company goes from private to VC control and then to the IPO, okay, 1, 2, 3 stage. Assume that you have a private business operating in a sector where publicly traded companies have an average beta of 1 for the sake of simplicity, and where the average correlation of firms with the market is 25%. Okay, correlation coefficient, you need to divide the beta by correlation coefficient, right? And then consider the cost of equity at 3 stages. Risk-free rate 4%, equity risk premium 5% using CAPM. Stage 1, the nascent business with a private owner which is fully invested in that business. So you are exposed to the total risk of the business, right? So beta divided by correlation coefficient 0.25, which is total beta of 4, okay? In that case, your cost of equity will be 24% using this CAPM model. Stage 2, angel financing is provided by a specialized venture capitalist who holds multiple investments in high-tech companies, and then the correlation of his portfolio or her portfolio with the market happens to be 0.5. This means divide your beta 1 by 0.5, okay? The marginal investors' portfolio's correlation with the market, which is 0.5. So perceived beta 1 divided by 0.5 should be 2. Okay, with this, your cost of equity will be 14%. Say stage 3, finally, you go through IPO process. After IPO, you're a public company, no need for total beta or whatever perceived beta it may be. No division happens, just beta 1, CAPM, 9% cost of equity, that's it. So to value this company, how does it work? Well, assume that this company will be fully owned by its current owner of the 2 years, for 2 years, will access the technology venture capitalist at the start of year 3, and that is expected to either go public or to be sold in a publicly traded firm at the end of year 5. So year 6 and on, it will be public company. Okay. Now, how do you do the cash flow projection and then discount it using DCF? Well, you see, let's take it over here. Risk-free rate and market risk premium is given over there. Year, right? Time horizon. You start from 0, 1, 2, 3, 4, 5, 6. Okay? And then you split the periods into 3 different stages. Initial 2 years, and then the subsequent 3 years, and the last going into the infinite horizon. Now, expected future cash flow is just given to you as an assumption, and then market beta 1, let's say it does not change, but the correlation coefficient that you have to divide into changes as your company changes from a completely private company to a venture capitalist involved company, and then a public company after IPO, right? So 0.25 and 0.5 and 1 should be your correlation coefficient that you divide into, right? Now, beta used will be your market beta divided by correlation coefficient, like this, right? Then cost of equity using CAPM will be 24% and 14% and 9% all the way down. And then terminal value, okay, terminal value, what is that? Well, at the end of year 5, you'll have to think about the terminal value of your free cash flow to equity, right? Now, here, the cost of equity going into the infinite horizon will be 9%, right, after IPO. And then your growth rate in a stable stage in this year 6 and forever, 2%. And your cost of equity is here, FCFE will be this guy, okay? Now, 175 divided by 9%, minus 2%, 7% essentially. That's this guy, right? So free cash flow plus terminal value of this free cash flow, right? Those should be this, which is this guy plus whatever on this cell. That's this guy. Good. Now the next one is interesting one, which is a cumulative. Oh, wait. The next thing is 1 over 1 plus discount rate. Year by year discount rate, okay, should be this guy. So 1 plus 24%, right? Yeah, that should be the denominator. So that 1 over this guy should be 0.81, okay? Same discount rate, same discount factor. And then 14% rate, well, 1 over this guy should be 0.88, okay? 0.88. All right. Then what do? You calculate something called cumulative discount factor. Some of you asked me over the email that what if my discount rate or WACC or cost of equity changes over time, and this is precisely that kind of situation. Your discount rate changes as your marginal investor characteristic changes from a complete private investor to a venture capitalist to well diversified portfolio managers. Well, here you just have to worry about 2 stages, right? Completely private companies and then venture capitalist, right? Those 2 stages. Here, what you have to do is cumulatively you have to discount it over time in a compounded manner. You know compounded discount factor, right? Compounded interest rate, compounded discount. But you are using just changing interest rate. You see the idea, right? So in Excel, what's the function that takes care of this kind of compounding, cumulative, changing discount rate? We say it product function. Product means cumulative multiplication. You remember sum is like cumulative addition, right? SUM, cumulative summation. Cumulative multiplication is called product, right? So I say product function starting from D12 to H12 over here. So D12 means D12 to H12 is this guy, right? So that you get this one. So all the way down to starting from this guy all the way down to that guy, you cumulatively multiply, right? Multiply, and that will give you 0.44 over here. That's what's happening over here. 3 periods, 2 periods, 1 period. Oh no. 5 periods, 4 period, 3 period, 2 periods, and 1 period. Okay, so that's the product function. Now what do? Get the present value of each cash flow over here, right? So multiply these two and get this. And over here, you multiply this guy by 0.44. That should be this guy, right? Now you're almost there. What do? Get the summation of all these things, right? That must be this guy. That's it. Okay? 1.5 was it million or billion dollars, right? So that's firm value. Okay, did I work with the free cash flow to firm? It does not matter. I mean, we just assume that to be 0 anyway. Firm value or equity value, yeah, that value equals 0. Let's just assume it, yeah, right? So that's that. The next 2 is like firm value prime and prime. What did I do over there? Here we are. If we assume 24% discount rate all the way down forever, that will be 1.2, okay, $1 million or something. If we assume 9% of discount rate over here, the fair value estimate will be 2.1, okay, $1 million. Okay, in which case it will be overvaluing in which case it will be undervaluing like that. And there, Excel function is NPV, and then parenthesis, comma, discount rate, and the cash flows. Cash flows, this guy. Yep, right. So that is it. Okay, so this is how you value your private company once you are assuming three different stages: completely private, venture capital, IPO public, right? Now, implication: the value of a private business that is expected to transition to a publicly traded company will be higher than the value of an otherwise similar private business that does not expect to make this transition. Private business is in sectors that are hot in terms of going public will be worth more than a private business in less sexy sectors. As IPOs boom or bust, private companies' valuation will increase or decrease. Private companies in countries that have easy access to public markets will have higher valuation than companies in countries without that access. Okay. Now, proposition 2 is that the value of a private business that expects to make the transaction to a public company sooner will be higher than the value of an otherwise similar company that will take longer. And private businesses will be worth more if companies are able to go public earlier in their life cycle. This time value of money thing, and the marginal investors of the buyers, not the sellers, okay, matter. So, if you have a choice, would you like to sell your company to a private company or to a public company? And the answer is public company, because their beta will be lower, and then the marginal investors of that buyers will be well diversified. Private company valuation, the value of a private companies will depend on the potential buyer. Okay, potential buyer, okay, not the seller himself. If you are the seller of a private business, you will maximize value if you can sell to a long-term investor than a short-term investor, because less of a liquidity discount, who is well diversified, whose investors are right, and does not think too highly of you as a person, does not who underestimate your value. Okay, don't impose yourself like I'm a super guy. No. Why? Because if you are perceived as a super guy in your business, the moment you leave that business, the buyer will discount the company's value. Oh, Andy, if you leave that Andy Kim company, it's 안고 없는 찐빵. Why? It's like the bread, how do you say? I don't know. It's like a cream of the crop is out of that. We have to discount it even further. So you have to pretend that you're nobody. I'm nobody, but you. So that's the idea. If you are valuing a private business for legal purpose like tax or divorce court, the assumptions you make, you use, and the value you arrive at will depend on which side of the legal divide you are on. Okay, those biases gets back to the class number 1. As a final proposition, always keep in mind that the owner of a private business has the option of investing his wealth in publicly traded stocks. There has to be a relationship between what you can earn on those investments and what you demand as a return on your business. Okay. Now, watch out for dubious IPOs. Here is one recent example. What is this? Some 알통. Okay, they're announcing in the newspaper 중앙일보 somewhere, advertising their IPOs, raising capital in the equity market, saying that they will beat Google as a search engine. Good luck, right? Therefore, their reports on all these disclosures seems dubious, right? Watch out, okay? Now, number 2, my memories, right? Good sweet memories with SKKU students over here, right? 2017 December, right? My students, right? Taegi and Hoini and all these guys, right? They got the first prize in KOTC competition, right? So if you're interested in this kind of what is it, the 공모전 kind of things, right? Pay attention to this called KOTC. What is that? OTC, over the counter market, right? They were valuing a private companies, right? As opposed to publicly traded companies, right? So these private companies, they had to value those guys' stock and do the stock recommendation. So they won the first prize, and I was lucky to be their leading academic advisor. So I won the prize. Yeah, 지도교수상, right? So I was very happy and proud of my students, and then proud moment, right, of celebrating it. So this is another reason why I was, doing this instruction for this private company valuation. So don't forget to divide your beta by correlation coefficient, right? Anyway, those deals and all those things in IPOs. I hope you become successful in your future. And then if you have any questions, please ask me through the email address that I give you down there, right? Okay, hope to see you. Bye-bye. All right.